Investing in stocks is all about creating wealth, but sometimes you just want to get paid. And that means dividend stocks. I'm going to talk about 3 dividend stocks that have a great track record of getting their shareholders paid and growing the amount that they pay them every single year. I'm Jason Hall. This is Investing Unscripted. Before we get to those 3 stocks, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should check out our special link. It's fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. Go to that link. Check it out. You're here to learn more about dividend growth stocks. 3 that I'm a big fan of right here on the screen. The chart you see is dividend growth going back to the beginning of 2014. So 10 years, Realty Income has grown its dividend every quarter. You get a little tiny raise every single quarter. 41% dividend growth. That's 41% more income per share that you're earning as a Realty Income investor today than you would have earned back at the beginning of 2014. SBUX and Home Depot, they've grown their payout at much, much higher rates than Realty Income has over that period. In fairness, there is a big difference in the amount of yield that you get if you invest in Realty Income. You can see the yield right now about 5.9%. That is on the higher end of where it has yielded pretty much any time over the past decade, and more than double the yield that you would get from SBUX or Home Depot stock. Depending on what it is you're looking for, there's a good chance that one or more of these stocks will offer exactly what you want. Let's start things off. Why investors that are focused more on yield and looking for a little bit of dividend growth over time may want to take a close look at Realty Income. If you've watched any of my videos where I've discussed Realty Income over the past couple of months, you've seen this slide from their most recent investor presentation. A couple of key things about it that I think are useful. Number one, it talks about the stability and the resilience of its cash flows. That's this pie chart down here in the bottom left-hand corner. If you're looking for dividends and you want that money, you need the income now. You don't want to see an interrupted stream of income. Having a company that its cash flows are pretty steady and unlikely to be upset by economic ups and downs, that's what you need. And Realty Income says that their tenants have pretty strong incomes, pretty resilient to economic downturns. Plus this part right here, isolated from economic pressures. This is a company that's got a 29-year streak of increasing their dividend, about 4.3% average over the past 29 years. But you know what? That beats inflation over that time period, and that's a pretty good benchmark to set. One thing that Realty Income is really good at, we got to be really good at, and that is making investments in property that generate a good return. $2.7 billion they invested in the fourth quarter, generates a weighted cash yield of 7.6%. If you look at the $9.5 billion that they deployed across the full year 2023, cash yield of 7.1%. That indicates that they're doing a better job of deploying cash than what they are having to pay it out based on the existing share price today. That matters a lot because companies like Realty Income will occasionally use their stock as capital to make acquisitions. The Spirit Realty deal that they did in 2023 that closed in January of this year was an all-stock transaction as an example. So it's important that you're getting a higher yield than your dividend yield when you make those kind of investments. That's a good benchmark for cost of capital and getting a good return. So we know Realty Income is delivering for its shareholders on that metric. Let's move over and talk about Home Depot. If you're watching this video, I'm sure you already know what Home Depot does, so I'm not going to really get too much into the details. I will talk a little bit about it later. But what I want to highlight is the company's sales performance. Frankly, wasn't great in 2023. Its fourth quarter revenue was down about 3%. Comps actually fell even more. If you look at the full year results, 3% decrease. Earnings per share were down nearly 10% last year. Why are you talking about this company if the business is going in reverse? And in short, because I think it's the kind of business that investors should definitely have on their watch list. 2023, it was a fine year for Home Depot. It just doesn't look great in comparison to 2022 and even 2021. It's because of the trends around home ownership, some other factors around single-family homes in the United States that I think is really important. As a starting point, the housing stock in the U.S. on average is about 38 years old. Americans' houses are getting old, but there are a lot of houses that people are going to be spending a lot of money on in the next decade to renovate, improve, and even expand. Higher interest rates, record housing prices that mean that more people may have to expand or improve the house they have versus buy a house that they want. And that means that Home Depot is in a very strong position for the future of home improvement. Now, it's not just DIYers. Home Depot has a really powerful business that it does with professional contractors. It's a really large part of their business. They offer special promotions, pricing, and other things for their pro customers. Those pro customers tend to be pretty loyal too, because Home Depot is going to have what they want, and it's going to be within proximity of the customers that they're serving. That is hugely important. It has a great financial profile. I'm going to share here on the screen. Even though 2023 wasn't a great year on the top line and the bottom line, it's a pretty good year for the company's cash flows. Operating cash flow in 2023, the most generated in the past 3 years, it was able to take that cash and turn around and invest it back into its stores, improving its technology, making some acquisitions. It deployed a lot of that cash and put it to work, creating a stronger, more efficient business. That's exactly what investors should want to see from a company like Home Depot. Okay, time to highlight Starbucks. And of these three, this might be my favorite right now. Starbucks is back. Specifically, China is back. After being locked down during the pandemic longer than really any other large country, China really reopened this past year. And as a result, Starbucks saw strong bounce back results. In its fiscal first quarter that it just reported, we saw it continue to grow. Revenues were up 8%. Comps were up 5%. On an international basis, they were up 7%. That includes China. Things are going really well. One more thing I want to share with Starbucks I think is really compelling is we have a new CEO that's in place who's making some changes to try to drive growth. In this case, a new executive structure to lead its core geographical markets. You have a CEO for North America, you have a CEO for its international business, and maybe most importantly, under that CEO for its international business, they're keeping Belinda Wong and Molly Liu in place, co-running Starbucks China, seeing some geographic focus in its leadership structure, its organizational structure. That should lead to more effective growth. Let's talk about keeping the dividends safe. So payout ratio is really useful. Cash payout ratio, I think, especially for these large, mature, stable businesses, is really helpful to use. Realty income, it may seem like 71% is high, but the reality is that REITs, they have to pay out at least 90% of their GAAP net income, their taxable net income, to remain a REIT and get that status where they actually don't pay corporate income taxes at the federal level. So 71% is actually a pretty safe, stable number. And then we see Starbucks and Home Depot at 56% and about 47% respectively. What that means is that their dividends, barring some catastrophic event, the dividends should be very, very safe for these companies. And it also means significant room to continue to grow those dividends over the long term. Now, that's good. You want secure dividends, but let's talk about whether or not these stocks, to me, look attractive as buys right now. And I want to use price to cash flow, operating cash flow, as a proxy for buying. We can also use PE ratio for Starbucks and Home Depot. Again, Realty Income as a REIT, price to earnings isn't super useful. Price to FFO per share, funds from operations, is a better metric. We can use price to cash flows, operating cash flows, as a proxy for that as well. So what do we see? Again, Home Depot, the most expensive at about 18 times operating cash flow, about 15.5 times for Starbucks, and then Realty Income about 12 times, which is a reasonable number. Of the three, like I said, Starbucks I think is my favorite, trading for about 15.5 times operating cash flows, particularly when I think those cash flows are going to continue to grow. Management's going to do a good job of continuing to return that cash to investors with the dividend, growing the payout, also repurchasing shares at a pretty high rate, while also still investing in growing the business. It's got about 38,000 stores. Their long-term target is 55,000 stores. There is a tremendous amount of room to continue to expand, not just in China. It's still growing in North America, growing in Latin America. India, I think, is a market that it's going to be able to grow at, maybe more than a lot of people are planning. But right now, we know China is really where it has a lot of focus on investing capital to continue to grow share in that market. So Starbucks, I think, is really compelling. Realty Income, I also think it's really compelling. Of this group, certainly has the lowest dividend growth rate, but a yield of 5.9% I think is very reasonable. Their ability to deploy capital to get effective return on that capital is bar none. And then you think about the size of the addressable market, opportunity to continue to expand, consolidate, room to continue to grow that business. It's well run. It's as stable as they get. Last, that leaves us Home Depot. What do we think about Home Depot? Number one, I think the long-term tailwinds are good. The age of the housing stock, their positioning with home improvement professionals. We haven't talked about how strong their omni-channel is. They have a wonderful website. It's easy to make purchases and schedule delivery or just pick up in a local store. Their incredible proximity to the vast majority of U.S. homeowners gives them a wonderful positioning for the long-term tailwind. It is definitely a business that I say buy. The stock today, I will say, it looks kind of expensive. It's run up a pretty good bit over the past year. There were great opportunities to buy it last spring, about a year ago, great opportunities to buy it last fall. It does feel like the stock has run up a little bit now, where I won't say it's not a buy, but I will say it's on the higher end of what I think is a reasonable valuation. I think investors would do better to maybe buy a little bit as a starter position, look to dollar cost average in when the market gives you better opportunities, or put it on your watch list, wait for the market to give you opportunities to buy at better valuations. I think you'll be glad you did.